Meantime, our next guest says markets shouldn't assume the worst of the tariff impact is behind us. Hamilton Lane co-CEO Erik Hirsch joined us here in studio. Erik, great to have you with us.
Nice to be here.
So the low that we saw isn't the low of this tariff trade war?
I don't think the court ruling is the end of this. I think the administration is clearly signaling that they're going after steel and aluminum and looking for any other way to continue to sort of exert leverage. They sort of have no choice. Otherwise, you are a dog with no bark if you're trying to negotiate here and everyone believes that the court's going to step in and just prevent everything. So I think the administration is going to continue to lean in aggressively wherever they can.
So how does your view of the market change or not change if this is a more drawn out sort of, because the scenario that you're laying out is a much more drawn out sort of negotiation where there could be tariffs in place, there could be exemptions made. It is an unknown sort of territory.
I think that's where we are. I still expect that we're going to see some sort of a get-together between Trump and Xi, and there's going to be some fanfare and a parade and ultimately a transaction. So I still am optimistic that that's where this is going. But in the intervening time period, I think we're going to be living in this world where we are up, we are down, we are sideways, and there is a lot of turmoil and chaos.
So, Erik, take me out 6 months. So past the turmoil and chaos, what do you think the biggest challenge is for the market? I think you've already stated that. So why don't we just attack? What do you think the biggest opportunity is once we clear that chaos?
Yeah, I think the opportunity is going to be all of a sudden you're going to see this demand kind of rush back in. I think we shouldn't kid ourselves. We're already seeing the slowdown and the pullback, whether it's hiring, whether it's goods, whether it's manufacturing. That's all here, and that seems to be getting worse, not better. I talk to very few CEOs that are saying, boy, we're feeling great and ready to make a lot of big capital decisions around that. So I think the opportunity is in a whole bunch of sectors, we all of a sudden see a whoosh as people begin to kind of come back in over the next couple of months.
We had Drew McKnight on last night. I asked him this question I'm about to ask you. Friday of last week, Jamie Dimon talks about the bond market having a crack or something happening. He was convinced it was going to happen, 5% to 10-year. What is that? If it happens, what does it mean for you? What do you think it could happen?
So I think it's a real possibility. I think you have enough very smart people, and they're probably giving you better answers than I'm giving you, but you've got a lot of smart people who are saying, we are seeing early warning signs and this is not good. Now, for us, selfishly, the private markets are a bit more immune from a lot of this. Our companies are not multinational. Our companies don't have long supply chains stretched around the globe. So we're not seeing a lot of impact in our portfolios. But if we see a big crack in the bond market, that is going to turn institutional investors completely upside down. You're going to see capital flows shut down significantly. So fundraising down, deal doing down, all of that I think will just grind to a halt.
So, Erik, back in the throes of the sell-off early April, we had a 10-year yield that was rising. We had a dollar that was going lower. So obviously bonds were getting sold and the dollar was getting sold and the stock market was getting sold. And now the stock market's up in the year. It's made all that back. What does it mean to you that the dollar's still down here right at the lows? And, you know, even with the 10 basis point move lower in the 10-year today, 4.35 is still higher than where we were on April 2nd. So are some of the things that are in place right here setting up for an equity decline if we do see a protracted sort of situation where they're not going to have a meeting, they're not going to reach any sort of, real short-term deal that would, be a phase one sort of situation?
And I think on the dollar, the market's telling us that it's not viewed as the safe haven that it once was. Period. I don't think it's any more complicated than that, because we should be seeing a rising dollar in an environment where we're sort of reshoring everything. We're not seeing that. I think there's only one explanation, which is it's not the safe haven that it had been promised or that it had been or perceived to be. So that dollar weakness to me is going to continue until we begin to see stability coming out the other side. It's causing investors to move capital into different places and to think about currency hedging in a different way, which is expensive. And it's why, again, one of the reasons why in our industry, capital flows are simply not what they have been historically, because there's a bit of a jam up for a variety of reasons, whether it's hedging, whether it's chaos, whether it's uncertainty. It just means money is not flowing at historical levels.
Erik, great to have you with us.
Pleasure.
Thanks for stopping
Thank
by.
you.